All right, that was an odd move today. We started off really strong, got up to new highs. Nvidia got almost up, got up to what, the 974, looking really good. Like we were going to finish the week strong, get up to a higher close, get to that 26+% level without a 2% decline, the highest that we've seen. So we were that close, and then things really changed on a dime. The dollar rose, Nvidia dropped. I think the Nvidia ended up dropping over 10% from intraday high to intraday low. Big move in that stock, and it caused everything else. Whether it was Broadcom and Marvell's earnings last night, not really helping fuel the AI trade as much, at least from the open. I mean, the jobs report came out today, and that wasn't both the bulls and the bears kind of had something to pick at. In the jobs report, with a lot of the jobs revisions from prior months, 30% revision lower in the last month. But then the unemployment rate rising, and so is the Fed going to cut rates or not? I mean, that's still a big thing, but it was that big Nvidia drop intraday, that 10% drop that really threw the markets for a loop. Ended up down on the S&P 500. Now the question is, okay, is it just an anomaly as we saw earlier this week when we had a 1% decline and we immediately bounced back up? Are we going to, when we expected that last week, are we going to immediately bounce back up on Monday, right? Is our expectation now going to be the same next week? Not quite, and I'm going to tell you why in today's video. Some cracks, more cracks showing up we'll discuss on the charts. And then, of course, our trade idea, a stock in that technology space that also had its earnings last night, didn't look so good. And what looked like a bullish breakout ends up kind of a bearish pattern. So we'll talk about how to trade that. Let's go ahead and get started. Today is Friday, March the 8th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video that I do before the market closes. We take a look at all the old Market Outlook trades to see whether we should stay in them. We already put on today's trade already before the market closed in there. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up this tab. Hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do this day in and day out. Our goal is to get to 100, and I think we've got more than we did the day before. So thank you again. Those who don't do that, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, another down day today, almost another percent down day, but 2/3%. The second down day of the third down day of the week, actually. Monday was a small down day as well. The near-term line drops, so this will be potentially the first near-term peak that's bearish, right? Again, you can kind of see when the near-term peak kind of hits here. We almost had a little one right there as well, right before that expiration date. But when the near-term line peaks underneath the reversal zone, then you start to work, especially when you're especially after getting like a cluster, right? They tend to, it's another sign of mature top. You can see you got these over here at the end of this intermediate run. And there's plenty of examples as well on previous intermediate rallies. There's the one I just showed you there, and you can see some of these others. When you get to the end of these intermediate runs, like here's that one at the end of that intermediate run, and then we broke down after. You can see this one was the end of that intermediate run after a cluster too, no less, and you broke down after. So you can see how that's a sign of a mature top. Now, again, we're not out of bullish territory, so we could bounce right up. Technically, this is a bullish intermediate confirmation signal, oversold momentum line, strong posture, bullish posture. But also, if you look at all these other instances, most of these other instances, when the momentum line is dropped into the reversal zone, and it was because of an actual down move and not because of really small days, like for example. Right here, you had really small days, and that brought the momentum line down. The near-term line didn't drop into the reversal zone there. Another instance right here, coming off of out of these, you had very small ranges, and that's what brought the momentum line. This one is not a small range, above average, and it's a down day. So those instances, usually the near-term line at least falls in the bearish territory. So a good chance that this ends up being a bearish peak. Intermediate line still is falling, but it's still in the reversal zone. Same with market sentiment. They're both falling. The intermediate line is still above the market sentiment line, so we're still fine. But again, you can see, that this is going to likely be a bearish near-term peak, and we're likely to get a drop. Now the question is whether the near-term line follows all the way into the reversal zone. Only one of these did, and we avoided anything by bouncing back up here on the 8th pretty quickly. So we'll see if that ends up being the case. But at least brought the intermediate line below its market sentiment and out of the reversal zone. So we'll watch to see if that ends up being the case here with the near-term line, if it drops below the 20th percentile or not. Unlike all the last 1, 2, 3, 4, 5, quasi 6, but really 5 times that the near-term line fell to bearish levels. So likely to do that again here. So you look at the NASDAQ 100. And you can see again, same thing, extremely low. The near-term line is out of bullish territory. It's not in the bearish territory yet, but you expected it will get there. The near-term line has crossed below market sentiment and has crossed below the 80th percentile. So a lot more bearish there. So light pink shading for the first time in a while that we've had. And again, last time we had light pink shading too, you had a bearish near-term peak. And this one comes after a cluster. So we'll see how that turns out. We expect that it will turn into something more weak here. You look at the Dow Jones. The Dow Jones also, the intermediate line has already crossed below market sentiment and has also dropped below the 80th percentile. It's actually further below than all the rest. Has already got a bull tag, the light pink shading and the yellow line. The momentum line also dropping to extreme lows. And this would be a very bearish. We already had a quasi-bearish peak there on the near-term line, only dipped its toe above 80. But this one would be really bearish, as it wouldn't even get into bullish territory. So things not looking very good at all. Kind of similar again to this one over here. And not looking very good at all for the Dow Jones relative to the other large cap indexes. Finally, your Russell 2000. The intermediate line's way up above the market sentiment. Nowhere close, right? Because the market sentiment's further lower than all the rest. Momentum line is not as extreme, not as extremely low. The near-term line is also pretty bearish, and we've already had one bearish peak and this kind of divergent peak here, and then this would be, again, a really bearish peak, assuming that we fall back off of this, which you assume that we will. And the long upper shadow, which is also bearish. So today was a down day, and by itself, we didn't drop 2%, we didn't even drop 1%. So by itself, it's not that bad of a day. But you can see it's producing some pretty weak signals on the market forecast that suggest some weakness coming up pretty soon, potentially as of next week, coming up pretty soon. At least some weakness in the near term, because the near term line is expected to get down to bearish levels, but also some weakness even going further than that if the intermediate line continues its decline. Remember, the weekly chart got we got the cluster there. The momentum line is in bearish territory, kind of like the near term on the daily chart. The momentum line is down there. So we're kind of done with this short term. We got a doji pattern up here, spinning top, which can be a reversal sign at the when you have a trending move going into it. Again, coming off of a cluster. The near term line is still strongly bullish. We're not in the 90th percentile anymore, but we were in the last 5 years. So we're still pretty strongly above the moving average. So, with the cluster being this far up above the moving average, not surprising that we get some signs of weakness here as well. It's not as strong. If you look at the Dow Jones, remember that was the weaker one on the daily chart. It's also weaker here, that you're almost in the reversal zone on the momentum line. The near-term line is out of the reversal zone here after kind of getting after the cluster it got earlier, and then the divergent high point here, the lower highs in the near-term line with the higher highs. And then again, the near-term line almost out of bullish territory itself and working its way into bearish levels. So not quite, but still in bullish territory. The Russell 2000, which remember has a lower market sentiment line in the daily chart, also has got a higher near-term line, the intermediate line just barely getting above the 90th percentile, but your momentum line dropping. Not down as far, but dropping here as we had a bullish week. And we'll see if this ends up being kind of one of those fake out weeks like we got right here, where we got that big fake out week and it turned out to be nothing, right? Well, this could potentially be a little bit of a fake out week here that we'll see if next week if it turns out to be nothing. As of right now, okay, strongly bullish. But, it's a spinning top, and spinning tops can be pretty bearish at the end of a trending move. And so we'll see if that ends up being the case this go around. I expect that we'll get some weakness here in the near term. And I expect that it will actually lead to finally that seasonal weakness that you tend to get. I don't think it'll be that big of a deal. I don't think the intermediate line, I do expect the intermediate line will get into bearish levels here, but I don't think it will dip. Might not even get to actually below 40. I do think it will get out of bullish levels. I don't think it will dip like, we'll get clusters or we'll get into the river. I don't think it'll be even that. It'll be probably something just like this. Maybe a toe dip below the 20th percentile. Nothing more than that. I think we'll get more weakness later in the year, but I think we'll get this weakness and then another one like it in the second quarter. Maybe a little bit weaker, but something like it. Again, Apple's a pretty good indication of the type of weakness. The S&P can catch down to Apple, but it's probably not going to go too much further since Apple's already, had 3 clusters and is already pretty significantly down below its moving average. So not a whole lot more downside to Apple, which will limit the downside of the S&P, even if NVIDIA is the one that causes the S&P to even to have pink shading at all. All right, let's take a look at the other weekly chart. And you can see, again, still a bullish candle. We still finished with a higher Hakunashi close. We still finished with a higher high, so everything's still bullish there. But you can see, like, the open next week will be at 50.87, and we're trading just barely above it at 51.23, which is actually, we're trading at 51.23, which is actually below this week's Hakunashi close. So next week's candle has a high probability of being a transition candle, where even if we don't get a higher high, or if we do get a higher high, we probably end up with a lower Hakunashi close, and we probably end up with both an upper and a lower shadow. So high probability that that's what we get next week. The question is whether or not that is an actual bearish candle and turns into a bearish trend, or whether it's also kind of a transition, a doji spinning top type candle as well on the weekly, and we just kind of start to converge. No big consolidation, but just a little bit of convergence to bring that intermediate line down from the lofty levels it's been at for so long. If you look at the weekly chart here, you can see we're still, today's decline notwithstanding, we're still easily above moving average. We're still above the 8-day, much less the 17 and the 30. MACD is below its moving average. Stochastics is below its moving average, so it's still in the reversal zone. So nothing too crazy there. The diamonds ended up back below its 17-day moving average just barely. You can see that. Well, actually a little bit above it, actually 30, by 8 cents above it by the time it was all said and done. The MACD has been converging for quite a while. It's actually almost negative. Stochastics is out of bullish territory now, heading towards the lower half of the chart. Remember, the Dow has got the worst margin of safety right now. It breaks that 30. There's not very much of a gap to the 50. So you can break the 30 and the 50 in one day and not be that big of a move. And there's a big gap down to the 200 if it were to follow suit, with not very much volume in between, considering we're well above the value area there. IWM, you can see, again, a little bit different, way up above its moving averages, and the 30 just barely crossed above the 50. MACD is still positive there. Going back to the S&P and looking at the weekly chart, so the daily chart's above all its moving averages, well, so is the weekly chart, right, since we're finishing up a week here. You can see, again, what the weekly looks like, well above the 8-week. MACD, though, the histogram is dropping. The stochastic is very high along with this moving average, but that spinning top, it remains to be seen whether that turns into a transition on the Hakunashi. But again, considering how high the MACD is here, which is still pretty high, about as high as when we got off the COVID low point, and the fact that the histogram is already dropping, the likelihood is increasing that we do get a reversal type candle that at least brings us to the 8-week, if not towards the 17-week in the next week or two. Let's look at some of the other oscillators. So the DMI, you can see not as bullish, not surprising. The negative indicator actually dropped today. Interestingly enough, it dropped down closer to 20. You wouldn't expect it to drop further if we were to keep going down. The diamonds both the positive and the negative are below 25. That goes to show how much that trend has finished. And then IWM, you can see still pretty strong trend with its negative indicators are still below 20, and the positive up easily above 30. When you look at the RSI and the CCI, the S&P still shows bullish levels above 60, above 100 on the S&P 500. If you look at the Dow Jones, we're below 60 and near like getting below 50, and we're below 0 on the CCI. So you can see how things are changing there. And we're still pretty bullish on the Russell 2000, up above 100, barely above 60. Not nearly as strong on the Russell, kind of diverging even on the CCI as what we saw on the S&P, where the RSI was above 70, still is above 75 even after this week's little spinning top here, and the CCI also still up above 100. But again, you can kind of see the cracks starting to show up here. The Ichimoku cloud. When you look at the Ichimoku cloud, again, well above the cloud, still very strong trend. That quality actually got bigger. Getting below the green lines, that's a sign of weakness when you have a very strong, mature trend. We're not there yet. Breaking below the blue line usually ends the trend, and that's the concern. When this trend quality and trend noise balance both hit 0, then your trend is done at that point. Generally, your trend is done. Very strong rate of change. If you look at the diamonds, that was the S&P. It is below its 8-day, and its trend quality is still pretty darn high, not quite above 20. But you can see just how close we are to the blue line. We are and the rate of change is not very positive anymore. We are maybe a day or two away from that hitting 0 on both of these. So that's how close we are to, like, again, this mature trend finally ending on these large cap indexes, with the Dow kind of showing out first. You're still in strong levels in the Bollinger Bands. The S&P is up barely in the upper quartile, but still in the upper quartile. The momentum's still positive. You're not above the upper Keltner channel anymore. Again, the diamonds, the bandwidth is really, really small. You are at the midpoint, but you haven't crossed below it yet. But you're flirting with the midpoint, and your momentum has really come down and is close to crossing into negative territory for the first time. So again, you can kind of see how the diamonds are starting to show some weakness because they don't have Nvidia in it. They don't have a lot of the other mega cap names. They have Apple and Microsoft, but they don't have any of the other mega caps. Amazon now, but not any of the other mega caps there. We did get a new 4-week high point earlier this morning. When we gapped up above today's, but then we closed below last week's high. So I mean, that was really bullish to be up above last week's high, but we ended up close. We did get a higher high. We got a slightly higher low from one week to the next, but we ended up not closing above last week's high for the first time in a while. Again, that's not as bullish, right? That's a sign of weakness for the markets. If you look at the diamonds, which remember have been weaker, your positive Arun has come way down below 70, is now below the midpoint of the chart, and you can see we are flirting like we have a few more days until the low point gets up to here and then to here. So we've really been dropping on the size. I mean, we're down way below 5% on the size of the channel. So the diamonds are really, really like coiling for a move, and again, kind of suggestive of what could be happening pretty soon on the spider. Even though we're still at 100 here, we're near the spiders changing, but you can also see how important the midpoint is. And when you look at that midpoint, we've only closed one day below that midpoint this entire however many months, and it was that day right there, and we didn't last very long. So again, a break below that midpoint, that's kind of, and we're not in the reversal zone anymore. That's kind of the next stage. Now, all these other times we dipped out of the reversal zone, we bounced right back into it almost immediately. A couple days on some of these other moves, but pretty much almost immediately. And we'll see if that ends up being the case today after this engulfing pattern. We'll see, do we bounce right back up? Do we get out of bullish territory again, which we've only done a couple of times? Do we dip into the lower half of the chart of bearish territory? That's kind of tells you when things are done on this. And you can see the Dow Jones, remember, not only is it not in the upper and bullish territory anymore, it has dipped its toe below the chart's midpoint over here, and now its stochastics, its average, 20-day average has come out of bullish territory. So again, that generally leads to the reversal. That's the kind of pattern that generally leads to this breaking down the reversal. And so you would expect that, again, sooner rather than later, probably as soon as next week here, or potentially after the options expiration there on Friday. If I were to look at today's range and today's range above average, 7 points, the volume, let's see, we didn't look at the volume here, so let's look at the range and the volume. You can see we don't have 3 green arrows anywhere except for the Russell 2000, which has had green arrows for a while. The Dow is the one that hasn't had it for the most length of time, but we had above average volume, we had above average range, so it kind of validates this move a little bit. Sorry, wrong chart. It validates that move, and you can see now we're back up above the 9. And again, once we break the 100% mark, that's when things can really start to take off up to the upside, and we're still nowhere near that even on the Dow. But you can see volume picking up, the range slowly picking up on a relative basis too. These lines move up, then that's when typically we start to be a little bit more bearish, right? The last volume pickup we kind of just had a convergence period. We went up and then sideways, but generally this is what happens when you get the volume moving up to the upside. All right, finally, let's take a look at the volatility index here. Where's that? The VIX down here. So not surprising, the VIX is up. The VIX has been up. Remember, the VIX has been up the last few expiration cycles, including this one. It's up today. It's been up it's been up for a few days here, despite the rally, right? We've been up most of this week here before today. The VVIX ramped up to 86. Remember, we talked about, the VVIX last week. We talked about the extreme low in the VVIX, suggesting that we would have a bullish week in volatility. Well, we had a bullish week in volatility. It led to a spinning top. But it led to a bullish week in volatility here. And when you look at this chart here, it led to the VIX almost above its 200-day moving average, which, remember, it only gets above its 200-day moving average during these intermediate declines. So it would be another sign that we would be potentially starting an intermediate decline here if we were to break up. And we did at the highs of the day, we were above it, but we closed kind of right, just a smidgen below it. But this is the closest we've been since right around the options expiration last month. All right, if you take a look at what's driving the price action here, again, you can see U.S. equities is really killing it. But the weakness in the dollar here has really been driving a lot of this strength. And even this week, the past few days, as you can see the gold move higher. I mean, it's really been an odd move in the dollar and the 10-year yield. We'll take a look at that here in just a second. But I think the dollar's been your biggest driver of weakness. That's been driving a lot of the strength, is that weakness in the dollar. And we started off weak here. We ended up coming off the lows in the dollar. Yields were slightly higher today, commodities down. But the Qs were actually up, and small cap index stocks were really up. They were up 1.5% this morning. And then the wheels came off. Qs ended up being down 1.5%. Small caps ended up the day down on the day, slightly down, but down on the day. Gold ended up another day higher. So that's, again, going all the way back to last Wednesday, its first day. Gold's up 7% over 1, 2, 3, 4, 5, 6, 7, 8 days. A 7.25% move on gold with that weak, especially on the really weakness in the dollar here lately. Bonds are still holding up. Real estate, so your traditional safety trades are all really kind of exploded today. Outside of the dollar, they all kind of exploded. And equity started off this period week, kind of had a little surge last Friday and Monday, and then kind of came down again Tuesday and Wednesday, then had another surge at the end of the day Wednesday and into Thursday, early today, and then now back down to where the Qs ended up finishing up only up 1/3%. IWM's up 1/3%. But still underperforming treasuries, underperforming international stocks, not surprising considering the weakness in the dollar. No, except for some odd reason I don't see high yield on here. Let's see if I can maybe change this to a daily chart and we can see the high yield move. You'll be able to barely see the chart here. Yeah, I'm not really sure why high yield's not coming up. But here we can take a look at high yield on this chart. Let's go over here to this ratio chart, and we'll look at how high yield is doing relative to IEI. It's similar duration treasury index, and you can see dropping down below here. Let's go to a 1-day chart, 1-year chart, sorry, on a daily basis. You can see high yield for the past couple weeks breaking down below now the 17-day. So a little bit of bearishness on the high yield. Its PPO very, very high, and now its histogram almost has gone negative. So things are turning a little south relative to IEI. If you do it relative to investment grade, you can also see we have broken the 30-day average on that ratio chart with the MACD and the PPO both falling down as well, long-term PPO and some of these ratios falling. So you can see even high yield starting to show some cracks in its strength. If you take a look at the breadth was actually really, really strong early in the day. We were up above 50 on the McClellan oscillator, so very, very strong. You saw the IWM was up so high. By the end of the day, remember, IWM finished down, but Qs finished down way more than IWM did. So we ended up about half, ended up down below yesterday's move, but not down very much, right? Only down to 25. So the breadth was actually not too bad. When you look at the number of stocks above the 50-day moving average, it increased again. It increased pretty much almost every day this week. You can see here, if I were to go back to, let's see, it'd be March the 1st. So that would be a week ago. So March the 4th, it was up. One dip on Tuesday, and then every other day this week it was positive. So we went from, on March the 1st, we were at 346 to 389, well above the moving average. I mean, this is a very, very good sign. The new highs index, this is updated for today, but I think this is still just the New York Stock Exchange. But you can see the average is up to 320 now. Another like very, very strong moves in the past week or two on the new highs and new lows. So pretty strong breadth here. In fact, when you look at the, let's see here, the bulls and the bears on, how high the bulls and the bears are, the average is up almost at the 10-week average is already pretty strong, right? It got up to almost 25. It's been rolling over a little bit. But now the 40-week average is up pretty strong. It's almost to 15. Again, that's about where we peaked in 2021, was up around 15. It was about where we peaked here in 2015 before the sentiment changed. So getting now, it got way high back over here in 2004. But in terms of recency over the last, 15 years or so, getting up to around 15 is a pretty high level. And we're diverging here. You can see we diverged over here and sentiment changed. We're diverging again with lower highs and higher highs here, and wondering if that's going to lead to a significant change in sentiment. You would expect it would lead to a significant change. This is what the bulls and the bears actually look like. The bulls again up above 50. We got above 50 last summer. We got above 50 a couple of times last year. Once, post-COVID. Once when we had the change, the election results, and the vaccine release. So that bumped kind of a week, big move higher. That kind of broke us out of that intermediate decline. And then we had it again here. This would have been March and April, right at the very end, 3 weeks in a row above 50. March and April, kind of right at the height of the inflation when that first started, really surged right there in March and April, and that kind of led us up. Again, that was also the end of the reopening trade. It started over here and ended with that surge, and then the reopening trade was done, but the Qs kind of led us up into the end of the year before the correction started. But a year later, when you go a year later from that surge, by April of the next year, we were actually down. So it can mark a short-term top. It can also mark a relatively long-term top too, at least in recent times. And you can see active investment managers up above 90%, which is an extreme level for it. There's the 90% mark. And then down here as well. Other sentiment indicators, but this one in particular, the AAII, that's again, we were above 50 earlier in this cycle, and we kind of broke through some of the highs on that bullishness. Got right up to that 4,700, big surge up above last summer's highs to get through that level with a big surge in bullish sentiment. And now are we going to surge again? And this time, though, we're getting a little bit of a doji pattern, and that's the kind of patterns that don't necessarily, especially when we're already in a mature run, that don't necessarily, back that up, confirm that extreme in sentiment there. Let's take a look at how the sectors performed today. So bear with me 1 second while I bring up the sector comparison chart. And let's go to March the 8th. You can see, I'm not surprising, everything's down. NVIDIA was a big driver of today's weakness. So as much as Apple went up, today XLK was down because of NVIDIA. So XLK really dropping, real estate down the most. If I were to go to the end, for just this whole week, XLK ends up down on the week, XLY ends up down, XLC ends up down. So on a week where the S&P is down 0.25% with some pretty big ranges to the top and to the bottom, your biggest losers were what's traditionally been your biggest winners, right? If you were to go all the way out to where this whole thing started, when we started off of that October the 8th, or the Halloween low point there, those have been the three of the bigger winners, and then now they're obviously starting to show some signs of weakness as they're starting to rotate in the wrong direction. Here's their relative rotation graph on the daily chart. Again, XLY is in yellow, XLK is there. It's been improving thanks to NVIDIA, but it's there in the blue in the improving category. XLY has been moving down to the left. That's Amazon and Tesla. And then XLC is in the lagging category. The only ones that are still in the leading are industrials and materials, losing momentum. And then you have real estate, staples, and utilities moving towards the leading. So again, a sign that market's moving towards safety right now. You can see the relative strength of XLK to the market, which again is NVIDIA and Apple. Here's the daily chart below its 50-day average on the relative strength line, and you can see the momentum may be peaking here before relative strength even gets above 100. So a sign, kind of a sign of weakness there on the daily. If you look at the weekly version of this. Here, let's zoom out so we can get some context. So we'll go out to the 5-year weekly. Again, you can see, the relative strength and momentum dropping on the weekly. We're not in, they're not both below 100, so they're not in the lagging quadrant. They're in this, on the weekly chart, they're in the weekly quadrant there, or weakening quadrant as we are moving towards the moving average. And that happens, right? When you get this extremes in relative strength, it's kind of hard to really build on any relative strength from that point forward. Especially when you've had this strong move with less relative strength, this strong move up to a higher high off of that, this pretty historic move up to a higher high, again on less relative strength than what we had seen previously. All right, that brings us to our trade idea of the day, which is actually on DocuSign in this space. So let's go to DocuSign. It had its earnings. Let's try this again. I'm just fat finger clicking on everything here. So let's go over here and then we'll go to DocuSign. So it had its earnings announcement. It broke up. Now you notice after previous earnings, we had a nice good bullish response to that earnings, and then it just took off. But all the other earnings, we did not have such a bullish response, and we dropped. This one was obviously a bearish response. We rallied and then dropped. This was not such a bullish response, right? It would have been great had we opened at 55.97 and then closed at 58.90 where we opened, but it was the other way around. The near-term line jumped up, but not to bullish levels. The intermediate line still in bearish territory. You're up 4% above on this bear tag, but that's not a very high number, relatively speaking. So it's not really the best bullish breakout pattern there. If you look at the 3 green arrow chart, we did not get 3 green arrows today. The stochastics is still down. We got 2 green arrows, but we haven't had the third third one yet, and I don't know if we'll get the stochastic to turn up before we drop below that moving average. That's kind of the anticipation. We opened well above the 50. We traded back below the 50. There's a good, again, considering the filled in candle, there's a good chance that ends up being the peak, and we have this kind of move is what I'm anticipating there. The DMI is not that strongly bullish. It's good bullish breakout patterns above 30, below 20 on the negative. Your ADX is still down there, but again, we've already had such a strong trend. You wouldn't expect a breakout to a new strong trend already this fast. Same thing with the RSI and the CCI. They got up to pretty decent levels, but above 200 on the CCI, but not above 60 on the RSI because we closed off of the highs so much. And then you look at the Ichimoku cloud here. We didn't finish above the cloud. We're still in the cloud, and we almost didn't finish above the blue line, and we're still below. The rate of change is still negative, and we don't even have a weak bullish trend because we came off this. So not as bullish as we'd like to see on that breakout move. So what I decided to do here was to do a more conservative long put vertical spread. So I bought the at the money put, sold 52.5. So if you notice here that in the analyze tab is kind of messed up here, but I sold here and bought up here. So it gives me about a 1.5 to 1 reward to risk ratio on that. And you can see let's see here. We get that return if it breaks back down below these moving averages, right? So it has to get back below 52.5 by April expiration. 52.5 is basically back below where we were just at right before the earnings. And considering, again, not this response, because we responded pretty bullish and we maintained it, but the other responses, especially like this one here, which had a very similar gap way up and then come down, if we have that kind of response again, that's the kind of that will easily lead to our maximum gain on that trade. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, follow and like me on Twitter and Facebook as well. Join us at marketscholars.com. Have a great rest of your weekend, everybody, and we'll see you all on Monday.